Good morning. Welcome to Flaya's Real Estate Direct Lending and Private Debt Forum Part 8. This is the eighth event in our series. Today, we'd like to thank our sponsors, Nationwide, Preqin, Boomerang Capital, S&P Global Market Intelligence, Safe Harbor Equity, the Mortgage Office, Harvest Volatility Management, Millennium Trust, Apex One Investment Partners, Intrust Global, Off the Chain Capital, Clarion Asset Management, and LinkVest for making this event possible. We'd also like to thank all of our Flyer board members and the Flyer board for their support during these challenging times. If you're not familiar with Flyer, Flyer is a 501c6 nonprofit organization that was started in 2007 with the goal to become the world's leading marketplace for alternative investments and alternative investment education. Since then, Flya has helped thousands of firms in the capital raising process, aided in the allocation of billions to alternative investments, and leveraged technology to accelerate the due diligence process. Today, Flya has grown into an organization with over 5,000 members, with over 3 trillion in discretionary AUM. We'd like to thank you for attending our conference today. Enjoy the day. Jeremy?
Hello, everybody. Thank you for joining us for part 8 of the Real Estate Direct Lending and Private Debt Forum. First up, we have Julian Guerin, who's a partner at Macro Strategies Partnership, and he's going to talk about the Great Reflation. Julian, are you there?
Yeah, I'm here. Hi, everyone.
All right, Julian, I'm going to stop sharing so you can share your screen, okay?
Sure thing. Well, greetings everyone from lockdown London. I hope conditions are better over there. And I'll kind of kick off once my screen has got itself up and running, which hopefully should be now. And I'm going to talk today about the Great Reflation. Our key call kind of back in mid to late March, was that the massive global and coordinated policy response to the lockdowns would generate over time a major reflationary recovery, both in markets and in macro, that would over time also then morph into a new inflationary era. Now that's very important indeed for kind of alternative assets. If we start to think about the various kind of asset responses over the course of the last kind of 10 years or so, the last 10 years has been mainly a disinflationary period. And in that kind of period, in that kind of environment, we tend to see an outperformance of property, for instance, that's in the higher end of the property markets. We tend to see an underperformance or an outperformance of credit and loans that are in long duration assets, particularly focused on quality growth. And we tend to see an outperformance in broader equity markets, tech stocks, etc. But in a reflationary environment and an increasingly inflationary environment that we expect to see over the coming years, we'd expect to see a very different type of outcome. Property markets, for instance, would be characterized by the cheaper property markets going up the most, which was something that we saw in the 2000s, which was much more reflationary. Credit markets and loan markets would tend to see shorter duration assets, particularly involved in cyclicals like energy or broader kind of basic materials and basic industries tend to outperform. And within equities, we'd expect to see a similar type of outperformance in value cyclicals versus growth. Now, how do we work out that we're going to see a reflation? Well, the critical thing that drives reflation is that dollars have to flow from the US offshore. And the reason that that's so important is basically because there are two dollar economies. And on page 3 here on the left-hand side, clearly there's the dollar economy that operates out of the United States. That has about $50 trillion in it of cash in circulation, bank loans and other forms of debt. Then there's a second dollar economy that operates offshore that has about $18.5 trillion of dollars in it. And you can see that on the left-hand side of the screen there. It's got about $1 trillion of cash circulating in places ranging from kind of Libya to Iraq in red. It's got about $5.5 trillion of kind of pegged currencies. And then there's around 11.5 or $12 trillion of dollar debt. Half of it is dollar-based kind of dollar deposit-based bank lending, taking place offshore out of the purview of the Fed, and half of it is dollar issuance by corporates and sovereigns offshore. And to understand why this is so important in generating reflation, it's worth going back to how this whole offshore dollar economy started, which was during the Arab oil embargo of 1973-74, when you had gas lines around the block, as you can see on the picture on the right-hand side of your screen. Nixon was in a panic, and he sent Treasury Secretary Bob Simon to Jeddah and told him he couldn't come back until he got a deal. Well, he was stuck in Jeddah for 3 months. The amount of whiskey drunk was measured apparently in bathtubs rather than bottles. But through the haze, he knew what he was doing. He was an ex-head of Southern bond trading. And he got the deal. And the deal was that the Saudis would resupply the US with oil. All oil trade would be done in dollars. The Saudis could buy treasuries secretly via the Caymans. But in return, the US would provide the House of Saud with full political and military support. Now, while that was necessarily done on a handshake, it was nevertheless it's remained extremely solid ever since. And the Saudis were making so many dollars, they didn't just buy treasuries, they made large dollar deposits in banks in Geneva, in Paris, and in London. And the treasurers of those banks had to paying out double-digit rates, had to put that money to work. So they started lending the same way that they got the money offshore in dollars to Brazilian local governments in the north of the country, building hydropower dams with aluminium smelters attached, and to trade into commodity finance. And 30 years later, they were lending it to local governments in the west of China, building coal-fired power stations with aluminium smelters attached to commodity into trade finance. So when offshore dollar liquidity booms, when dollars flow offshore, you basically fund the supply chains that feed global trade. You see a boom in global trade, you see a boom in resources, you see a boom in emerging market investment, and that at its heart is the reflation trade. Now, the way that we kind of look to identify this in terms of the financial flows, because there are two types of flows of dollars offshore. There are financial flows, there are trade flows. Now, on the financial flow side, we use our indicator, an excess global dollar money supply indicator, that captures both the push and the pull of dollars moving offshore. And the push is when US money supply is running well ahead of nominal GDP. Effectively, there are more kind of dollars washing around the system than are needed to fund GDP growth. And some of those excess dollars look for higher returns offshore. So that's the push. And then the pull is when kind of money supply offshore is growing faster than the GDP. Money supply in dollar terms offshore is running faster than global GDP. And that's an indication partly that the dollar's on a downtrend, partly that offshore central banks are doing QE, and partly that offshore commercial banks are lending. And that's a signal that returns for US-based investors for investing offshore are on a rising trend, and that tends to act as a magnet, dragging capital flows out of the US. And what you can see clearly on this chart here is that there are three kind of zones. The zone above the top red line, that's when you've got a lot of global dollar liquidity, a lot of money flowing off outside from the US offshore, and that tends to drive a reflationary boom. When you're in between the two red lines in a kind of neutral zone, that tends to be an environment where there's not enough dollars flowing offshore, so there is still a good environment for domestic credit in the States. And that tends to be an environment where you get a disinflationary boom, with tech stocks doing very well, etc., and high-end property doing well. And you can see that we've been in kind of that zone for most of the last 10 years. And then when you drop below the bottom red line, that's when there's not even enough funding for domestic credit. And that's when you tend to see deflationary bust, where all risk assets go down. Now, so far, clearly, our call that we'd start to see reflationary pressure build has started to work. We can see that we're well above that top red line in the reflation zone at the moment. However, the response from markets has been somewhat narrow. We've seen some improvement in things like precious metals, base metals. We've seen some weakness of the dollar. We've seen a broad risk-on environment. But we've had a couple of things that haven't happened. That normally happen in a reflation. We haven't really seen bonds sell off until really the election, and we haven't seen an outperformance of cyclical value in credit or in equities against growth. Now, I put that down to the fact that there were 5 key circuit breakers, and this was from a piece we wrote in early October. There was concern about kind of a contested election. There was concern about a return of COVID in the Northern Hemisphere and persistence in the Southern Hemisphere. US consumers had increased savings sharply. There was a delay to the stage 5 fiscal stimulus, and there was a connected delay to the Treasury drawing down its cash balance at the Fed. But my argument back then that as those circuit breakers that were preventing the full power of policy from reaching in and kind of driving a full reflationary recovery in markets, as those circuit breakers improved, we would see a major reflationary jolt run through markets. And since that time, we've seen 3 out of the 5 circuit breakers improve significantly. We're starting to see a significant reflationary response in markets, and we'd expect the last 2 to also improve. Now, the first circuit breaker was concern over the contested election or a potential contested election. Clearly, the result of the elections so far, in that Biden has kind of taken leads of more than 10,000 votes in various key swing states from Pennsylvania to Georgia to Arizona, means that it's going to be very difficult for recount to overturn those votes. And we're rapidly kind of approaching the point at which the local kind of states will certify their elections. So Georgia certifies tomorrow. We see Pennsylvania, Michigan certifying next week. Wisconsin will certify on the 1st of December. And as that happens, the route to effectively contest the election will narrow further substantially. And so it's very clear that markets are going to be able to look through the potential or the attempts to contest the election through to the strong likelihood that we're going to see President Biden in office as we go through January. So that first circuit breaker is improving sharply. There is one key final uncertainty, which is that the 2 Georgia Senate runoffs will be decided on January the 5th. And that will be critical to the determination as to whether the Democrats can control the Senate as well as the House and the presidency. If that does happen, then we're going to have a more aggressive fiscal. I'll come back and talk about that in a minute. Now, the second key circuit breaker was concern over COVID, and particularly the second wave in the Northern Hemisphere, persistence in the Southern Hemisphere. Now, our argument there had been that, that we would see the disease kind of fade away as we went through, in the Southern Hemisphere, as we went through the Southern Hemisphere summer. Now, the key thing about kind of death rates and kind of hospitalizations in the Southern Hemisphere is that they tend to rise to a peak around 1/3 of where they reach in the Northern Hemisphere due to kind of higher humidity and all year-round temperatures. But then they persist for about 3 times as long, and then they then fall away as you go into the Southern Hemisphere summer, which started a couple of months ago. And that's what you can clearly see in the chart on the top right of your screen there, with Brazilian, Australian, and Indian death rates now coming down quite markedly. Now, in the Northern Hemisphere, what tends to happen is you get a much steeper spike kind of in the initial kind of wave of contagion. That then falls away going through the Northern Hemisphere summer. And then you get an echo bounce, which typically sees kind of hospitalizations and deaths rise to around 1/3 of the peak of the previous pandemic. And then after 2 or 3 months, that then fades away and the disease tends to go into complete abeyance. We can just start to see that fading beginning in the UK, for instance, in more heavily infected parts, and that's in the bottom right of your screen there. In the more heavily infected areas, like London, it's already very decisively fading away. So our broader view was that the COVID kind of crisis, if you like, would ease substantially as we went through the next 6 months. However, that doesn't mean that fear around COVID would fall away. And on that basis, our view was that it was vital that a vaccine, an effective vaccine, was created. Now, our call had been, now we're not vaccine experts, but following those that were, our call had been it was quite likely we'd see an effective vaccine come to market. That's not clearly happening with both Pfizer and Moderna kind of reporting above 90% kind of effectiveness ratios. And we're going to see those that vaccine kind of distributed really quite widely in the US to begin with, and the UK to begin with during Q1, starting in December during Q1. then increasingly around Europe through Q2, and then increasingly through emerging markets through the second half of the year. And that will be decisive and very important in closing the second major circuit breaker, preventing the power of policy reaching to a reflationary outcome in markets and in macro. Now, the third key circuit breaker was consumer savings. What had happened in the second quarter, consumer savings, this is the chart on the right hand of your page there, consumer savings typically have been running at 1 to 1.2 to 1.3 trillion annualized as we went through the fourth quarter of last year, for instance. In Q2, a combination of very generous kind of COVID relief benefits, plus an inability to spend under lockdown, and we saw a massive spike in savings up to a 4.7 trillion annualized rate. So that effectively offset the impact on aggregate demand of the major fiscal stimulus. Now, what's now happening is that those consumer savings are now coming down sharply as people start getting back to work and as benefits start tapering. Not only will that add to aggregate demand, but it's also going to add to the current account deficit. That's the second key driver of reflation. And I'll come back to the other key driver of that current account deficit, which is going to be what's going to happen to government savings. Now, those first three circuit breakers have improved dramatically. We started to see the impact in markets as reflationary trades start to outperform, bonds start selling off, and value cyclicals start to outperform growth. But there are a further two circuit breakers that are still in play. And the first one of those is the stage 5 fiscal stimulus. Now, we had been seeing kind of some kind of attempts to get closer between Republicans and Democrats on that kind of front going into the election, with the Republicans raising their offer for the stimulus up to 1.8 trillion, and Pelosi bringing down her demands kind of for the stimulus down from 3.5 to 2.2 trillion. The Treasury have now kind of handed on the responsibility for negotiating to Mitch McConnell, and we seem to have been kind of hit a couple of snags on that basis. However, I still see it as highly likely that we're going to move towards some form of stimulus that will likely be in the order of around $1 trillion to $1.5 trillion as we go through the next kind of 2 or 3 months. Now, not only will that be very substantial in terms of GDP, somewhere between 5 to 7.5% of GDP, but it also means that we have a reduction in government savings, and that reduction in government savings raises the current account deficit. That then also becomes very reflationary. Now, there's a connected issue, which is that since kind of March, the Treasury has issued around 3 to 3.5 trillion more debt than it was intending to, as it's to battle the impact of the lockdowns. But it put about 1.5 trillion of that effectively in a piggy bank under a mattress in the Fed, where it wasn't getting lent out. So that money was taken from the banking sector, where it was being lent out to markets and to the economy, and added to money supply. But once it got to the Fed, it wasn't being lent out to anyone. So it subtracted 1.5 trillion from money supply, effectively offsetting 1.5 trillion of the Fed's QE program. Now, and you can see that increase in the Treasury's deposits at the Fed in the bottom left of your screens. Now, what the Fed has committed to, what the Treasury has committed to, is that it will draw down that cash balance by about $800 billion to fund the stage 5 fiscal stimulus. So once that stimulus is signed off, we're going to see a very significant re-injection of liquidity and money back into the system, and that's going to be highly reflationary. It's going to add to money supply. So you're going to get 800 billion of liquidity from this Treasury drawdown of its cash balance, plus another 600. This is over a 6-month period, plus 650 billion of QE. QE could well be accelerated at the Fed's meeting in the middle of next month as well, due to concerns this fiscal hasn't been signed off and it'll take some time for vaccines to be fully distributed. So it could even get even more money supply from that. And then there's a third key kind of driver of liquidity and money supply, which is the banks. Now, the banks in the last cycle were insolvent. We estimate that they had loan losses equivalent to 16% of loans at peak. And they spent the next 5 years, kind of from 2009 to the beginning of 2014, reducing their loan books. And as they did that, that offset about 80% of the positive liquidity impact of QE1 and QE2. Now, this time around, the banks have come into this downturn with 3 times the capital and twice the liquidity that they went into the GFC. They haven't been involved in the more egregious end of the loan markets through the last cycle, like kind of mortgage servicing rights, for instance. They haven't seen the rise in delinquencies that you'd normally expect in a downturn in mortgages and auto loans and credit cards, because the benefits of basically this kind of benefits in COVID relief have actually caused a reduction in those delinquencies, at least for now. And consequently, we think that they're in much better shape to start lending. And we believe that the banks will start lending, tentatively at first, as the recovery takes hold during next year, perhaps adding 200 billion to liquidity or money supply during that 6-month period, but then more aggressively as we go through the second half of 2021 and into 2022. And so this is a very big difference between this cycle, coming cycle, and the last one, is that the banks are going to be adding to liquidity that the Fed is pushing into the system and not taking it away. That's much, much more reflationary than what we saw over the last decade. Now, the combination of the Treasury drawing down its cash balance, increasing its deficit, and consumers reducing their savings is contributing to a major increase in the US current account deficit, which could well come to $1 trillion over the course of 6 months. Now, that again is very, very reflationary. That's $1 trillion of extra aggregate demand for the global trading system, which accelerates global trade and all the kind of economies connected to it. And it's also $1 trillion of extra funding for global trade, which again helps support growth on that front as well. And so this combination of factors, in our view, sets up a highly reflationary outcome over the course of the next couple of years, a highly reflationary outcome in terms of macro and in terms of markets. However, normally in a cycle, and what we normally saw over the last 40 years, is that after we saw that initial recovery, we then get the fiscal and monetary authorities tightening. In our view, this isn't going to happen this time around. We think that the fiscal and monetary authorities are going to continue to stimulate. And this means that this reflation that we're looking for on a cyclical basis is set to morph into an inflation as we go deeper into the next cycle. And that's going to be critical in thinking about asset classes. Now, there's a very good book about inflation called kind of Paper Money by Adam Smith, which is the pen name of a New Yorker writer, J.W. Goodman, who's both a financier and kind of an author. And from that, you get a much better sense of what really drives inflation than any kind of dry textbook on the subject. And the key thing that comes through from that is that inflation isn't caused by just one thing. It's caused by a whole range of supply shocks that undermine the income of the median worker in the developed markets. And we've kind of at MacroStrategy documented many of those supply shocks, ranging from globalization to the rise of monopoly. But whatever the approximate cause, the outcome has been very clearly shown in this kind of World Bank elephant chart on the bottom of your screens there. Basically, that shows the income growth of the various deciles of the global economy kind of in the 20 years after the wall came down. So what you can see is the back of the elephant is the high income growth for emerging market middle class. The tip of the elephant's trunk on the right-hand side is high income growth for the high income earners in the developed world. But the base of the elephant's trunk is the stagnation of incomes that we've seen for the median and lower income earners in the developed world and in the US in particular. And that, in our view, has been the basis of or the fundamental cause of populism that has driven the Brexit vote, that's driven the kind of rise of extremist parties in Europe, and that led to the kind of election of Donald Trump 4 years ago. And the critical point about this is that that populism has driven a major change in policy that we're likely now to see over the coming years compared to the last 40-year period. And the first part of that change in policy is fiscal. Basically, fiscal had always taken a kind of recessive kind of part of the policy mix over the last 40 years. The biggest fiscal stimulus was 5% of GDP, kind of from Obama at the bottom of the GFC, but he took that away after about 18 months or so. Now, this time around, even without kind of the Democrats taking the Senate, I would still expect to see, after a 20% of GDP kind of deficit this year, budget deficit this year, I'd still expect to see something close to 15% next year, and then 8% or so going forward. Those are very, very big deficits compared to what we've been used to historically. And if the Democrats do take both Georgia runoff Senate seats, which is not my base case, but could happen, if that were to happen, then you'd probably add 5% to both of those kind of deficits over the following years. So this means much bigger flows of trade flows, much more aggregate demand for the global trading system, much bigger flows of capital going into that system. So it's highly reflationary. But budget deficits on their own are not enough to drive reflation. When we saw kind of the biggest two kind of parts of fiscal profligacy over the last 40 years was Ronald Reagan's kind of tax cuts and defense spending kind of budget blowout kind of in the early to mid 80s, and Trump's kind of tax cuts going into 2018. But in both those cases, the Fed pushed up against that deficit spending by, in Volcker's case back in the early to mid 80s, running very high nominal and real rates. And in Powell's case in 2018, raising rates and running quantitative tightening. Now, the critical point here is that the Fed has now changed its tune and is now looking to accommodate this fiscal largesse going forward. And that was really crystallized in Powell's kind of speech, kind of back at Jackson Hole over the summer, where Powell kind of argued that, and he kind of crystallized kind of ideas that Lyle Brainard and Richard Clarida had been talking about at the Fed prior to that. And he said that in this cycle, the Fed wouldn't tighten kind of monetary policy, even if unemployment went below U star, or kind of full employment, i.e. if unemployment went towards zero. And even if inflation went above P star, or the 2% core PCE target. And the reason for that was that core PCE, as you can see on that chart in the blue bars, has been below target for the last kind of 13 years or so. The Fed is concerned that if it allows that kind of thing to continue, that inflation expectations become unanchored and cause a deflationary effect. And what the Fed is now saying is that it's target core PCE over the medium term. Now, in order to get core PCE back up to the 2% target over a 15-year period, the Fed would have to accommodate or stimulate inflation sufficiently that it was running at 4%, double target for the next 3 years, just to get back to that trend. So the Fed has an extremely large amount of capacity to continue stimulating, even if inflation gets up to 2% or beyond over the years to come. And this means that critically, the Fed won't be tightening into the recovery. It's going to continue to stimulate into the recovery. And again, that means that reflationary pressure will continue to build and add to the already kind of the reflationary recovery that we're expecting. And that will then start to generate inflationary pressure. Now, what does this mean for asset markets? Well, the way we tend to kind of think about this is using the investment kind of clocks that I put there on the screen. Basically, what this is it's a capital flow driven kind of investment kind of clock. And the idea is that the kind of capital flow environment is one of the quadrants of the cycle on the left. And they apply to the same kind of quadrant in the investment theme in the middle, and then the actual investment kind of advice, if you like, on the right-hand side. And what we're arguing is that very clearly, we're in the top left-hand corner at the moment. We have a large amount of excess credit and potential capital flows going into emerging markets, supported by a rising current account deficit. That puts us very clearly in a zone one reflationary boom. The types of things you want to do in that environment is to buy kind of cyclicals like miners, commodities, energy, emerging market stocks. Within credit, as I mentioned earlier, and loans, you want to go short duration with cyclical pricing power. You want to be short the 10-year, and you want to be short the dollar. And then in due course, I'm arguing that we're going to move to the right-hand side of zone 2 inflationary bust. And when that happens, you have to be more careful about equity exposure because equity risk premiums start to rise. You need to look for underlying hard assets like commodities. So how do we kind of think about these types of asset classes that you may or may not want to own in an increasingly reflationary and inflationary environment? And just a word, at macro strategy, we just do top-down stuff. So we're not making any individual stock or credit or loan recommendations. These are just for illustrative purposes. But basically, our argument is that what you want to look at, both in equity and in kind of credit and loan space, is that you want to look for short duration value. Now, in fixed income, short duration is a fairly well understood term. Effectively, it's about how quickly you can kind of see your both capital and kind of interest repaid kind of when you own a credit or debt instrument. In equities, it's a little bit more muddy, but broadly speaking, the way I've defined it is how quickly can you pay down your equity out of free cash, or if you're a financial, out of net income. And the types of companies that are showing up in the screens that I've done here for the developed world are companies like energy companies, Japanese trading houses, kind of metals and mining companies, basic industries, basic materials, kind of banks show up a lot, food producers and food retailers. Effectively, all the kinds of sectors that have been hated over the last 10 years, I would argue, are now going to perform the best over the coming years. Now, what kind of thing doesn't look so good? Starts showing up long duration risk. Well, that's on the bottom right-hand side of the screen. Again, we're not making individual stock or credit recommendations, but it turns out it's the types of companies that have longer duration risk, the companies that have been favored over the last decade, companies that are like quality growth, your Coca-Colas, your Procter & Gamble's, etc., all the way up to very long duration kind of growth stocks such as Netflix or Twitter. And we would argue that after a decade where the big tech stocks have seen four main tailwinds, they've seen fantastic earnings growth in absolute terms relative to value cyclicals. They've seen a re-rating on the back of falling bond yields and falling equity risk premium, and they've largely avoided any kind of regulatory pressure. We now think that there are going to be four main headwinds for these companies. And the first headwind is that we're going to start seeing, and first of all, kind of you'd expect their earnings growth to be less exciting coming out of the lockdowns, and also as you start seeing reflation helping the earnings growth of cyclical companies and energy companies and miners, etc. But then the second thing is they're likely to be derated in absolute and relative terms as bond yields rise and as equity risk premia pick up. And I did a quick study, kind of creating kind of 5 generic companies, kind of with different types of duration, from 5 years up to 100 years in the chart on the top left there, with 5 years being typical of something like a coal stock and 100 years being typical of a loss-making kind of growth stock. And I asked what would happen if you took kind of 10-year yields up from 0.7% when I did the study up to 2.8%. And the bottom line is that the 5-year duration company sees a derating of about 15%. But as that's likely a cyclical company, and as it's reflation causing that rise in bond yields, you'd expect to see earnings up a lot more than that, and consequently it would still make strong positive absolute returns. However, for companies with 50 to 100-year duration, they'd see a derating of a third to a half, and as those are secular growth companies and aren't necessarily influenced that aggressively by the cycle, that could then mean that they actually see absolute declines. And then finally, we now expect the regulator to put substantial pressure on tech and on the growth stocks. And I think it's been quite easy to be cynical of regulation and its impact on kind of big tech over the last 15 years. Big tech's basically run rings around the regulator, and regulators had previously only thought antitrust took place if prices went up to the consumer, and you couldn't really argue that for kind of services like kind of Facebook, etc., or Google. However, that has all changed, and the kind of tech antitrust subcommittee led by David Sisline, whose picture is on the top left there, has undertaken an 18-month study where they've been interviewing tens or hundreds of businesses along and reading millions of emails that they've subpoenaed from the big tech companies. And they released their report on about 3 weeks ago now. It's about a 450-page report. I've read it, and it's damning. They've compiled a huge amount of evidence pointing towards systemic and repeated abuse of market power by the big tech companies. And there will be a very large amount of pressure on those companies and potential significant increase in regulation. Now, clearly, there'll be more if the Democrats take the Senate. There'll be some offset if the Republicans retain control, and I suspect that offset will be less regulation of data use, for instance. However, I still expect to see substantial pressure on various market practices. I think one of the recommendations or implicit recommendations that I highlighted was that the committee felt that the charges that Google and Apple put through on users or on apps that were on their various app stores at 30% were egregious and should be cut down to something more like 5%. Now, it's interesting that we saw Apple yesterday announce that it was cutting its charges from 30% to 15%. That's just the beginning, in my view, of a process showing just how clearly the tech companies are starting to worry about this regulatory pressure. And I expect that Apple, Google will have to follow, but that Apple will be put under substantial pressure to lower those charges further. And that's just one set of recommendations. You'd also expect potentially pressure on Facebook to divest itself of Instagram and WhatsApp, and pressure on Amazon to stop trading on the same platform that it provides third-party traders to sell on. So these are potentially very significant regulatory pressures. And so I'll conclude there. And open up to questions in a second. I think the key message from this that I would put forward, though, is that we are now entering a new reflationary and inflationary era. This is a complete change from the last decade and more broadly from the last 40 years. We'll start with reflationary pressure that we're now seeing pushing through into dollar flows out of the States, driven by strong money supply growth within the States and increasingly attractive returns offshore, driven also by an increasing current account deficit. And that then has the potential to morph into a new inflationary era as both the fiscal authorities and the monetary authorities continue to stimulate even through a recovery. That's going to make a major change to the outlook for financial assets, both mainstream and alternative. And we advise investors to work very and look very carefully to ensure that their portfolios are extremely robust in the face of potential reflationary and inflationary pressure. And with that, I'll open up to questions. I'll stop sharing my screen and hopefully be able to see some chat or other kinds of Q&A. At the moment, I can't see any questions that have come up during my talk. So, Michael, I don't know if you've seen some showing up.
Yeah, I have a couple of questions. What are the industries that you're seeing? Can you go back into detail about what are the industries you're seeing that will benefit in this environment?
Yeah, no, sure thing. So basically what I'm looking for is looking for pricing power in the face of a reflation and an inflation, and looking for an ability to pay down the value of your company, your equity, in a short period of time. So I call that short duration value. So what's been performing for the last decade is basically quality growth. You can look at a whole range of companies, consumer goods companies ranging from Coca-Cola to Procter & Gamble, those types of companies, not making individual recommendations, all the way through to the big tech, the big tech stocks. What I expect to do well going forward is a range of companies that have pricing power, and I expect, for instance, energy companies to have significant pricing power in this environment. When you see a reflation take place, you tend to see the majority of growth in the world taking place in emerging markets. In emerging markets, their consumption baskets are very different from the consumption baskets kind of in the West. They're much more kind of resource intense. And so you tend to get an increase in intensity of use of a whole range of resources, from soft commodities, from wheat to cocoa, through to base metals, through to bulk commodities like iron ore. So basic materials, energy, basic resources, basic industries, those all tend to do well. Food producers tend to do well. Food retailers tend to do well because they have good pricing power into a kind of an inflation. The banks tend to do well because they see a combination of two factors. One is rising kind of yields, which then gives better net interest income. But the second thing that also helps them is they tend to see an acceleration of growth. Again, the last decade saw the banks heavily regulated. They saw them running down their kind of loan books, saw them facing a flattening yield curve. That was a kind of toxic combination for the sector. Over the course of the next 3 or 4 years, we expect the opposite. We expect somewhat easier regulation, notwithstanding potential for kind of things to come out of the Biden administration. But we certainly expect a steeper yield curve, and we expect them to accelerate their lending. And the banks will also do quite well because we think they've over provisioned, given that actually we haven't seen an increase in delinquencies in many areas.
Okay.
So those are the types of companies that we think that we will.
We've got several questions in, so I'll read some to you. Are you okay with making your slides available?
Yeah, sure.
Okay.
Yep.
All right, so we'll do that. What is your view on emerging market debt and equity?
Okay, in this environment, I expect emerging market debt and equity to perform well. I think that the critical part, and there's two or three factors that will tend to drive that. So in a reflationary environment, when you've got large kind of dollar flows out of the US, what tends to happen is that you get a combination of improving trade, which tends to initially at least improve the current account positions of a lot of emerging market economies, and especially also commodity producing economies. So you've got dollar flows happening for that reason, and you also tend to see dollar flows happening for financial flows as well. And when those dollars get into emerging markets like China, for instance, the central bank will tend to print its own currency in order to kind of purchase those incoming dollars for its FX reserves. Now, that process means accelerating money supply at home, and that means easier credit conditions, and that tends to be very attractive for risk assets in emerging markets, ranging from kind of property to resources to credit and to equity in those areas. So it tends to be a very bullish environment for emerging markets, kind of equity and debt, in steep contrast to what you saw over the last decade, where there was an absence of those capital flows.
Okay. Another question we have is, what are your thoughts on gold or Bitcoin?
Okay, so this is an environment where hard assets should do very well. The way to think about a hard asset, and kind of gold is the sort of classic kind of hard asset, is that gold will tend to do well if the US is debasing its currency. And by what I mean by that is, if the US is running money supply faster than its nominal GDP, that means that each kind of dollar is less able to buy GDP. It can't buy as much as before. Now, the last time that we saw a sustained period where that was happening was from 2001 through to 2007. And so even though there was a decently strong recovery, we saw money supply outstrip kind of GDP in each year up to 2007, and gold kind of more than doubled in that environment. That's exactly what I think is about to happen here. I think money supply has started running well ahead of nominal GDP in the US. I expect that to continue over the coming months and years. And consequently, I think that's a very attractive environment for gold. And I think that it could more than double over this cycle. Now, Bitcoin, I find a bit more complicated to analyze, basically because it doesn't tend to behave quite the same as a classic kind of hard asset like gold. For instance, gold kind of pulled back somewhat in kind of September and October, ahead of the election on concerns that stage 5 fiscal stimulus wasn't being done, and that could be somewhat deflationary. Bitcoin carried on rallying. I'm also somewhat concerned that I don't know who the main players are. So kind of the founder of Bitcoin, for instance, has as much Bitcoin as the German central bank. I don't know what he'd be doing with, or she would be doing with it. However, I can certainly see the hard asset kind of qualities of something like Bitcoin. And I can certainly see the degree to which it's becoming increasingly tradable. And so I would put Bitcoin in the same category as gold, as being a potential substantial beneficiary from the reflationary environment and potentially inflationary environment that I anticipate over the coming years.
Okay. What impact will this have on commercial real estate and housing?
The broad kind of impact that I would expect is that it's going to be broadly, or it's basically going to be attractive for real estate in general. I think that you have to be quite careful about which parts of real estate that you're talking about. And so in kind of the last decade, where we were in a disinflationary environment, disinflationary meaning there wasn't much in the way of capital flow offshore, the real estate that tends to do best tends to be kind of high-end real estate. So you're thinking about Knightsbridge property in London, or kind of New York penthouses, or kind of high-end Miami beachfront. When you're in a reflation, it tends to be the cheapest property that does best on the residential side. So in the UK, for instance, it was Belfast property that did best in the 2000s. Globally, it was Vietnamese urban property that did best. So you're looking for cheaper property in growing areas. On the commercial side, I think what I would argue is that kind of, and very clearly we've seen this kind of structural move towards kind of warehousing being some of the best commercial property. What I would argue over the kind of course of the next few years is that logistics and kind of basic industries, commercial property should perform well on the back of this type of environment, which would be a significant distinction or difference from what we saw over the course of the last decade.
Okay, so do you see more inflation of goods and services, or rather inflation in real asset prices?
Yeah, so I think in the initial reflationary period, before actual inflation starts to pick up, I think you can see asset prices rise to begin with. That's what you tend to see at the beginning of most cycles. But as inflationary pressure starts to build, and I'm kind of looking for this transition from reflation to inflation to take place kind of broadly in 2022, but as kind of core PCE heads towards 2 and then heads above, and then markets and investors start to kind of anticipate that the Fed could allow it to run upwards or through 3%. At that point, you tend to see some kind of increase in the equity risk premium. And so you start to see a transition, if you like, from Wall Street gains to Main Street gains. And I would expect to see kind of hard assets and real price inflation to become increasingly important and dominant as we go through 2022 and beyond.
Okay, so Nigel wants to know, what are your top 3 and bottom 3 emerging market economies?
Okay, so in terms of the top 3, we did a piece kind of about a couple of months ago, called How to Moneyball China, with the idea that kind of a bit like Billy Beane, the sort of general manager of the Oakland A's, in the book by Michael Lewis called Moneyball, he lost his best players and had to, and his owner wouldn't give him enough cash to buy new stars, and so he got kind of idiosyncratic kind of cheap players who together could get on basis much. My argument was that we could recreate kind of China's resource performance of the 2000s with some very different emerging markets this time. And I think the one that really stands out to me is India. India stands out because when I first started visiting China kind of back in the late 90s, it was just at the point of takeoff. And the key things that identified that it was about to do that was, number one, its urban population had got up to about 35% urbanization. Incomes in cities had got up to about $5,000, and we were starting to see significant reform programs taking place. This time around, today, India's urbanization is at 35%. Its urban income is approaching $5,000, and Modi is putting through some profound kind of development reforms. And so India looks to me like it has the potential to be the major structural story, if you like, of the next decade in emerging markets. And so I find that attractive. Indonesia, with a population of about 260, 270 million, is interestingly advancing very quickly up the S curve, the intensity of energy use curve. And so Indonesia looks like a very interesting or attractive proposition. Now, in terms of kind of, and that's in terms of growth. In terms of kind of equity exposure, there's often an advantage to being very export kind of focused or oriented in terms of potential to drive quick development and strong equity moves. And Vietnam would probably come at the top of that kind of group or list. So those would be my three favored kind of emerging market economies. Where I'd be more concerned, I'm more concerned about China. I think China can muddle through in this environment, and particularly with kind of strong capital flows and the potential for an opening up of its bond market, which could be quite substantial in terms of bringing in capital flows. I think it could bring in kind of $1.6 trillion into China over the course of the next 4 years. So that would be kind of, but structurally, it's kind of gone through its major development process and is kind of burdened by a bad loan problem and an insolvent bank problem. And so consequently, while I'm not negative on China, I'm not arguing it's going to be the best kind of the best focus for investors.
Okay. Is there anything else you kind of want to summarize?
No, I think those are the key points. Good questions, everyone. Thank you.
Yes. Well, we have a few more minutes. I think we have another question, which was, what sectors of the U.S. do you see, like geographically? How do you see this reflation affecting?
I think, okay, so that's probably a little bit finer detail than we would normally go into. But what I would probably argue is that as this is going to be a kind of reflationary recovery, it's certainly going to be benefiting basic resources and basic industries. And consequently, while the shale patch is under kind of severe pressure at the current time, and we've seen kind of a major kind of pullback in terms of investment in that area, I would argue that kind of oil-centric kind of areas are likely to improve as kind of energy markets tighten over the next kind of 3 or 4 years. And once you're starting to kind of push pricing kind of, back towards 60 and above, I would expect to see kind of sharp cyclical rebounds in those areas. I'd also argue that kind of some of the Rust Belt exposure to kind of basic industries could see significant improvement as well, partly on the basis of kind of reflation, as we've discussed, but partly on the basis of onshoring too. So I think I'd be looking for some of those areas to be potential outperformance.
Okay, well, thank you so much. We have definitely enjoyed your presentation. You've done a really great job and informed everyone about your theories.
Great. Well, thanks very much, everyone. Thanks.